That's the theme of this Diwali special. I'm your host, Surabhi Upadhyay, and helping us get on that path to prosperity in the new year, we have with us Radhika Gupta of Edelweiss AMC, as well as Ashish Shanker of Motilal Oswal Private Wealth. Ladies and gentlemen, thank you very much for joining in. First of all, happy Diwali to both of you. And I want to start by saying a thank you, because you've been partners in the wealth creation journey over the last 1 year and the last many, many years. So, happy Diwali, Radhika. Opening thoughts.
Happy Diwali to you, Shubhi, Ashish, all your viewers. I think opening thoughts, there should be a lot of gratitude for the last 1 year of Samvat. I think I was looking at mutual fund numbers. You look at any category of funds, returns are 40%, 50%, 60% on a 1 year basis. I think the Indian economy has never looked better from a macro standpoint. I think it was a year where I say that if there was a movie theme to define the year, it would have been Swades. Because in a period of such relentless FII outflows, we've seen such strong retail participation, such strong consumer confidence into our own equity markets. So I think the word to sum up the Samvat should be a lot of gratitude for what we've got.
I think that's beautifully put, and it's something that investors must keep in mind. We need to start with gratitude. Completely agree with you on that. Ashish, your thoughts?
Yeah, so happy Diwali to you, all the people at CNBC and your viewers. I completely echo Radhika's thought on gratitude. I think it's been an amazing year, and sometimes we forget the mood we were in last year, and we look at near-term developments. If you look at last year, the same time, we started in a situation where there were geopolitical tensions, and we almost thought there's going to be a third world war. You had planes flying over Taiwan, so on and so forth. So considering where we started, I think this year has been spectacular. I mean, the index itself on the equity side has done about 28%, and like Radhika said, you've had schemes which have done 40, 50%. And the best part, Surabhi, is that all asset classes have shown. It's not just equities, right?
Correct.
Gold has glittered again.
30% gold.
Absolutely. So gold has glittered again. Fixed income has done reasonably well because interest rates have come off. So really, we have no reasons to complain. So a lot of gratitude, and we should go cheerful into the next Samvat.
No, absolutely. I completely take your point as well. Well, that's the thing, Ashish. You spoke about planes flying, and the planes are still flying. It's a question of now whether you're talking about the Middle East or it's still Ukraine, and there are still a lot of risks out there. The fact that markets have managed to climb all these walls of worry and mountains of worry, I mean, does it sort of make you a bit nervous, or do you think there's been good reason behind the rally and behind the buoyancy that we've seen this year?
Yeah, so obviously there's very good reason behind the rally, and like Radhika said, our economy is looking in extremely good shape, and I think this will be the 5th year consecutive double-digit earnings growth for the Nifty. It has never happened in our history, including 2003 to 8. So there is a lot of good news which is translating into this market returns. There are risks on the horizon. I mean, some of the geopolitical tensions have continued to linger. And then you have the big one, which is the US elections, in 10 days' time. I believe that once that is behind us, things will settle down. But having said that, given the situation where we are in, and that's the reason, I think we had met probably a month and a half back, and I'd echoed this thought that, people should go into this Samvat with a balanced portfolio.
Correct.
Right? Whilst things have been extremely good, but there is no reason to be carried away. So there are two things I would advise. One is moderate your expectations. What has happened in the last 2-3 years is very difficult to replicate in the next 2-3 years, although the next 2-3 years look pretty good from an equity point of view. But at the same time, the risks are lingering on the horizons. So have a balanced portfolio and continue to have some gold in the portfolio. I mean, gold has obviously glittered. Maybe the returns on gold moderate, but I think you look at gold now as a risk or an insurance to any untoward happening at the global level or even in India.
That's typically how it should always be looked at, right? But it's become a, asset class in its own right. People look at gold for now, generating more wealth, not just sort of to hedge their portfolios. That's been a new thing, and we'll come back to gold and we'll talk more about it. But Radhika, the story of the Indian retail revolution, that's been absolutely phenomenal, right? What are your thoughts? We've spoken several times through the year on this 40,000 crores that keeps coming into mutual funds month after month. And what now? Because we speak at a time where this is the first, so to speak, test for equity investors, where markets have not been going up in a straight line.
I travel the country a lot, especially now increasingly because of our expansion to tier 2, tier 3. And one, I think everybody understands the equity story. In fact, I often think we underestimate sort of the confidence even in tier 3 and tier 4 in India and the interest in mutual funds. I mean, I'll go to a tier 3 or tier 4 town where there's no airport connectivity, but thousands of people will show up for an equity meet. So I think the India equity story is a structural story. Month on month when the SIP numbers come out, there's almost a sense of surprise, or they're 20,000, or they're 22,000, or they're 25,000. I do believe you will see in India not far from now where you have a 1 lakh per month broad SIP book. So I think that is a realistic possibility because financialization is genuinely just about to start. Now, as far as correction, of course, we've had a lot of new investors come in after COVID. I think seasoning of investors is a natural process. We had seasoning of investors who came in 2006 and 2007, learned some hard lessons in 2008 and they have become wiser. I don't think net-net the Indian retail investor is acquiring wisdom. When markets fall, people are adding. People aren't closing down SIPs. There's a lot of awareness. Yes, there are the old mistakes that are repeated. So my theme for the year has been Dal Chawal in a year when 50% of the money comes into thematic funds. The idea is to move people into the middle path, tell them not to do too many exotic things. So that will happen. But finally, I think consumer confidence in equities is here to stay. A little bit of moderation needs to happen.
Okay. So now let's get to the task at hand, and that is to try and ensure that we remain on the path of prosperity. Come what may, markets can go up and down, but it's our job to ensure that we are very systematic and hygienic and disciplined when it comes to our portfolio. So Ashish, let's straight away get to it. Like you said, yes, even earlier this year, you have had a tilt towards more balanced strategies. It's not like full whole hog into equities anymore, right? Tell us why.
Right. So one of the reasons will be is that, look, it's 3 years into a bull market, right? I do believe valuations are not super expensive, but at the same time, they're not cheap. They are probably in the reasonable zone. There are pockets of exuberance which investors need to be wary of, and like Radhika said, a lot of money coming into thematic funds, and some of the thematic funds have fallen about 25-30%. So I think people have got a wake-up call. Whilst we continue to remain bullish on equities, I think there are risks lurking in the background, whether it's in terms of geopolitical tensions or in the near term, earnings slow down. I mean, we saw this quarter, I think the downgrades were more than upgrades. So these things happen in the midst of a bull market. So as a result, I think having a balanced portfolio just helps smoothen the ride. So equities is one asset class which clearly we continue to be bullish on, albeit with moderate expectations. Gold, we continue to be positive on for different reasons. I mean, we were bullish on gold as an asset class maybe a year back, and we believe gold will perform well. It has done extremely well. But expecting gold to deliver these kind of returns year on year is very difficult. So I think gold now takes the original role of a protector in the portfolio, right? So if something goes wrong on the global front, then gold tends to shine, and it also gives you the much needed firepower to rebalance. One should look at fixed income because, given where equity markets are and the way gold has rallied, fixed income gives you that cushion in tough times. So having a little bit of fixed income, and we do believe that interest rates will go lower in India, and even globally that's the stance of most of the central banks. So if that happens, you can get a little bit of upside. And for people who have larger portfolios, structured debt, etc., is emerging as a attractive option to enhance the yield in the portfolio.
So let me ask you, if you were constructing a portfolio from scratch today for a medium risk investor, how much of each? I mean, how much equity, debt, fixed income?
Yes. So I would continue to be, more exposed to equities because when I talk about medium risk investors, somebody who's 30 to 40 years of age, I think equity still stands out as an asset class because you're still in the wealth creation stage of your life, right? So about 50 to 60% would still be equities. I would say 10 to 15% in gold, like I've always messaged, and the remaining portion could be in debt. And some part I always, believe should be in cash as an emergency reserve because that just helps you tide out volatilities in the market.
Okay, fair enough. So that's a good starting point. At least we have a basic sort of construct that each one can keep in mind. But Radhika, I want to hear your thoughts on a point that Ashish raised on thematic funds, and that's been the biggest trend of the mutual fund industry this year, right? There have been funds on defense, funds on consumption, funds on, any and every theme that you can perhaps even imagine. Now, what are your thoughts? Because in some cases, when the themes are extremely niche and narrow, like PSU or defense, the drawdowns and the fall in stock prices has been severe as well. So will this scare away people, or do you think the investors have matured enough? Your thoughts on thematics?
So I don't have a problem with thematic funds, but I think our definition of thematic funds has, evolved to be too narrow. In the old parlance of mutual funds, thematic funds used to be things like financials or consumption or manufacturing or tech. And so these were broad-based sectors, And even when these kind of thematic funds existed, my view was that these should be the satellite part of the portfolio. So if 80% of the portfolio is some combination of the things that Ashish mentioned, multi-cap equity, fixed income, gold, silver, international, then 20% was allocated to these thematic funds, and that is well and good. The problem now, and where I really get nervous, is the extremely narrow thematic funds. And I always tell investors to a couple of checks. Check one is exactly how narrow the sector is. So historically, we've seen retail investors, and in fact all investors, don't do the best job timing themes. I mean, last year, if you looked at the 10-year returns of PSU funds, it was single digits, less than 10%. You had a huge rally, a lot of funds were launched, and then, the numbers looked great. So people don't do a great job timing, don't do very narrow themes, and where you do themes, stick to that satellite part, and then I think people should be okay.
Okay, all right. So I think that's a good way of approaching the whole thematic space if it is something that you want to dabble in. And I guess, Ashish, you want to add to that, because we always hear about this core and satellite approach, right? So overall, would you keep thematics in a portfolio, and if yes, you'd limit them to what percentage, and what themes are you convinced on?
See, thematics by definition are for a little more sophisticated investors. I mean, let's say you're bullish on a particular sector and you don't want to spend the time researching on stocks, then you can go and buy a thematic fund, right? Or if you're a contrarian investor and a particular theme is not done well for the last 3 to 5 years, then you could take a contrarian allocation to that particular thematic fund. So I believe that, a certain portion of the portfolio can go into thematics, but like Radhika mentioned, a broader theme always helps. So for example, a year back, I think pharma as a theme had not done too well, and we were messaging that this is a sector which is ripe for re-rating, and you could have gone and bought a pharma fund. And pharma is a much wider theme. Similarly, for example, IT services, digital is a much wider theme, and those stocks have underperformed until three months back. Most of these stocks had derated, and we continue to be bullish on that particular sector. So, you have a core portfolio which consists of flexi cap, mid cap, small cap funds, and then you probably have 20-30% where you're trying to also apply your expertise. So for example, if someone is working in the IT sector and you believe you know the IT sector extremely well, and you want to apply that thought to markets, it's not a bad idea. I mean, you could go out and do that.
Okay, all right. So that's some advice on thematics. Good to keep that in mind. We do have to take a very, very quick break, but when we come back, we dive a little deeper into the perfect portfolio creation for the new Samvat. Back in just a moment.
Let's talk money. Let's talk money.
Welcome back. This is the Diwali special edition of Let's Talk Money, and we are ensuring that you remain on the path to wealth and prosperity. Come what may in the markets, they can go up and down, but you need to ensure that your portfolio is on track. And Ashish is going to help us do just that. He's already told us that Ashish, you're saying about 50% for a medium risk investor, 50 to 60% can go in equities. So let's go a little deeper. The industry keeps saying and experts keep saying buy large cap funds. People still want to chase the alpha. So you tell us some 2-3 interesting funds that you would look at for this new year.
Yeah, so what we are telling our clients is that you stick to flexi cap funds. See, a large part of the alpha has already been created. If you look at the last 3 years, although Nifty has done about 12%, the mid cap and small cap funds have done far better. I mean, they've done last year about 40-50% kind of returns. Obviously, a lot of the stocks in those sectors have got re-rated. So going forward, one needs to be a little more discerning. So some of the funds that we like in the flexi cap space are Helios, flexi cap fund. It's a small fund run by a veteran fund manager, has done reasonably well, and we are confident it will continue to do well going forward as well. And we like Franklin flexi cap. It's come back pretty well after all the challenges they had on the fixed income side. The equity team continues to do extremely well. And the third fund is 361 flexi cap fund. Again, it's a small fund. And the fourth fund, if I have to add, will be the Motilal Oswal large and mid cap fund. So we are preferring the slightly diversified portfolios to, let's say, concentrated funds like mid cap or small cap. Not that we are bearish on mid and small caps, but I think one has to become far more discerning. And a fund manager giving him the flexibility to invest across market caps is the need of the hour today.
Okay, fair enough. That's good advice to sort of keep in mind. On gold, Ashish, like you're saying that you're still optimistic on it. So would you keep the allocation to as high as 15% of the portfolio? And what is the vehicle? I mean, from sovereign gold bonds to ETFs and funds, how would you get into gold?
See, we've always been messaging for 10 to 15% allocation in gold. I think more the equity exposure, the more the allocation to gold. So if your equity exposure is in excess of 60%, then having 15% in gold helps, because then it acts as a insurance asset class. Because if equity falls, then gold typically tends to do well in those periods. Earlier, sovereign gold bonds was a fantastic vehicle to take gold exposure. But as you know, the government has stopped issuing sovereign gold bonds because it was too good to be true. But what has happened is the taxation on gold funds has become very favorable after this budget. So earlier, they were taxed at marginal tax rate. After this budget, they've again brought back long-term capital gains rate on gold bonds if you hold it for gold funds, if you hold it for more than 2 years. So the best way to take exposure is these gold funds which feed into the ETFs. So you have liquidity. At the same time, after 2 years, you end up paying long-term capital gains tax. So that's a great way to take exposure into gold.
Okay, got that. That's lots of advice on the funds to look at and how you can look at gold as well. Radhika, let me ask you, we spoke about thematics, but I also want to get your take on the multi-asset fund category, right? I think in this year, I have heard a lot on MAFs as a product. Now they're called, I think there's a fund house also running an ad saying MAFs, right? So why the appeal? Do you personally like these products? Because they do bring a blend of equity, gold. It can be multiple asset classes, right?
So I like the hybrid fund category in general. I think with the fixed income taxation norms, taking outright exposure to fixed income is not the most tax efficient, and people struggle. Even if you're trying to take long-term debt exposure, people struggle with timing fixed income. So I think blending equity and fixed income and multiple asset classes into a single product is very good. So whether it is aggressive hybrid, whether it's balanced advantage, or whether it's multi-asset allocation, I like the category. I think it's a very, very underrated category. And in fact, in bull markets like this, I think people tend to ignore this whole category of funds. With MAFs in particular, I think it's a very good category. The only thing is, in the industry, MAFs are the least well-defined category. So, you really need an advisor there to guide you on which kind of MAF, because there'll be people taking very low equity exposure, there'll be people taking very high equity exposure. So there's little less standardization in the category. But fundamentally, I think the idea of blending multiple asset classes into a single fund is very tax efficient for the consumer.
Radhika, what about you? I mean, if you were to look at suggesting someone an MF bouquet, and I'm sure you get asked this question all the time personally around friends and family, what would your recipe or advice be for the new Samvat?
So I keep it very simple. I say that if you're a moderate to aggressive investor, you should either be in flexi cap or multi cap. I tend to echo the view that mid caps and small caps are not cheap, but I think moving to completely large cap is not the best idea, because I think people should build decadal portfolios. And if you want an accurate representation of the Indian economy, you do need some dose of mid and small cap, because large caps are concentrated in a certain set of sectors. So flexi cap or multi cap tends to have a little more mid and small cap, flexi cap tends to have a little less, but flexi cap or multi cap is what I recommend. You can also do a large and mid cap index fund if someone wants to do that. For conservative investors, I am very pro a category like balanced advantage. I know it's not been popular over the last 1 year, but we are actually seeing that change in the last couple of months of volatility. So conservative investors can really look at balanced advantage funds. I really think they are all weather.
Okay, all right. Plenty of ideas there. So finally coming to last thoughts. And Radhika, you go first because I think the industry in the coming year perhaps will offer us newer concepts, strategies, and products because we know that the regulator has okayed this idea of a new asset class. It will be set up by asset managers like yourselves. So what should we expect from the MF world this year? And what would your one wealth tip be? Something to do or something to not do? Any wealth tip for this Diwali?
So I think the MF industry has been super innovative. If you look at the last year, for instance, the innovation that's happening both in the active and passive space is incredible. For instance, factor-based investing, particularly on the passive side, has taken off. You're also seeing a lot of factor-based ideas on the active side. So the MF industry never stops being innovative, and I say that in the best possible way. We are certainly very excited about what is going to come out of the new asset class, already cooking a bunch of ideas internally and working with SEBI to develop that. So I think we'll have more options on the platform for investors. I think wealth tip is keep an open mind because the world is expanding so much in terms of products and offerings, but also keep it simple.
An open mind, but also keep it simple. All right, that's a fairly evolved tip to be able to do both in a well-balanced way. Ashish, closing thoughts and your wealth tip for this year.
Yeah, so see, as the market keeps going up and, we continue to be positive on the Indian economy and markets, you will get a lot of narratives, right? So my wealth tip will be don't get carried away by narratives. Do your own homework, speak to your advisor, and then take a decision on the portfolio. Because, as various sectors do well and they show returns, it's very easy to get carried away into sectoral funds, into thematic funds. But we've seen in the past that ultimately it comes to hurt your portfolio. So beware of narratives. At the same time, be positive. And the next 2-3 years look pretty good. But, have some balance in the portfolio.
Okay, all right. Thank you very much, both of you. I think those are really enlightening ideas that are going to help our viewers. Radhika, once again, wish you a very happy Diwali and to you as well, Ashish.
Thank you.
And that's where we will take our viewers' leave on this special Diwali edition of Let's Talk Money. Here's hoping the coming many months and years remain very, very prosperous and positive for you in every possible way. Thank you for watching.
Let's talk money.